How equity returns can demoralize investors. How does equity investment work? What should an equity investor must know? To get answers to all these questions, we have our investment expert Mr. Chintan Arira with us. Chintan, the stage is all yours.
If we look at equity markets and why people are afraid, and I spoke of greed and fear, and why we invest in fixed income. As a investor, and this example in front of you is excellent. As an investor, what do we love? We love that if 100,000 rupees I invest today, next year becomes 1120, but at 12% return. The next year it becomes 1254. I get another 12% return. Keep getting that 12% return. I'm so happy. But the reality of our equity markets is, and why am I talking about equity markets? Because fixed income, we all are comfortable investing and we've been investing for long. Out of the 800 lakh crores that are there in India, as your and my savings, equity is only 5%. The rest is insurance, real estate, gold, fixed income, right? So there is a big way to go for Indian investors to participate in India's growth. And I'll come to some of the slides which are there in another pack, and I'll move to that presentation in a bit. But it is extremely important for us to realize this one concept, that equity market returns are not in a straight line. And that is why most of us run away from equity. If you look at the reality on the right-hand side, if I told you your 1,000 rupees after 2 years are going to be 970, just process it in your mind peacefully. 1,000 rupees are going to become 970 rupees after 2 years. Not that you know that it is going to become 970, but because market is such that it can fall, it can go up, etc. Because that's how equity markets work. Greed and fear, whatever macro challenges world has, etc. It does not move in a straight line. It's like an oscillating. It keeps oscillating like a wave signal or an electric signal pulse, but it's not in a straight line. It has a 45-degree curve. So in other words, in the long run, equity markets are up, but in the short run, they keep volatile. And that's what is depicted on the right-hand side. After 2 years, you are at 7% loss. What is the emotion that you will have? I've invested my money for 2 years. You tell your financial advisor, and you've not made any money for me. I could have kept it in fixed income and my 1,000 rupees would have become anyways 1,140 at 7% interest rate. Why did I even bother about equity markets? And if you see equity markets, the subsequent year, they are up 48%. This is just an example. Because equity markets move in that direction. If for 2 years they don't work, it becomes important for you to invest at that time and then take the advantage. It's not a straight line.
Thanks for your detailed answer. If you have any doubt regarding this or any other financial or investment decision, don't hesitate to book an appointment with our financial expert. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like, and if you are new to our channel, please do subscribe.